Hi, everybody. This is David Gully from Bentley University, and today's video is on tariffs and monetary policy. Please, if you have a chance, check out our YouTube channel, Bentley University EC391. So our agenda will take a quick look at the background of how tariffs work at the microeconomic level. Then we'll turn to see how tariffs can, if they're substantial enough, impact the macroeconomy. And then finally, based on that, we'll take a look at how those tariffs might impact the decisions of monetary policymakers. All right, so it's been a while, really, since the 1930s, since the US has been involved in a genuine tariff war. How far we'll go yet, of course, remains to be seen. Central banks, not surprisingly, including the Fed, have been working pretty diligently to try to figure out what impacts these tariffs might have and therefore how to respond. And a problem at the moment is that really there's no clear, and we'll talk about this in a second, no clear idea of, for example, which items will be tariffed finally, the scale of the tariffs, how long they'll last, what kind of retaliation there will be, and so forth. We have a little bit of information, but certainly there's a lot left that remains to be seen. Now, the first Trump administration imposed tariffs, but not to the scale or the scope of the current administration. And so as a result, this might have a larger macroeconomic impact and then therefore impact monetary policy as well. So let's first look at the tariffs at the micro level. So mostly tariffs and trade and things like that are introduced in principles of micro classes, sometimes principles of macro, but usually micro. And so are analyzed for looking at tariffs on one particular product. And so it looks at a very narrow impact so that a sort of a small situation can be studied. So really what a tariff is, it's a tax on an imported good. And so really what it can do is it can be treated as kind of like, an excise tax on some particular product. And what any tax does, including a tariff, it'll generate what's called a tax wedge between what the seller receives and the buyer pays. When there's no tax, whatever the seller receives is what the buyer pays. A tax, any sort of tax, including a tariff, causes a wedge or a difference between what the seller gets and what the buyer actually pays. And depending on the relative elasticities, the elasticity of demand and the elasticity of supply, that sort of determines how much of the tax the buyer actually pays and how much of the tax the seller actually pays. And then what we'll see in just a minute is, like any tax, a tariff imposes what's called a deadweight loss. And this is an important component of our discussion here. So a deadweight loss arises because you get two things. You get a decline in consumer surplus. There we go. Some buyers are going to be priced out of the market. And then output, as we'll see, rises above what is socially optimal. So those two things combined create what we call the deadweight loss. And so we have a visual on this here. So let's suppose there's a tariff imposed on imported sugar. And here's the situation. So this is from Greg Mankiw's book, very straightforward setup. And so let's suppose that the US is importing sugar. And the reason they would be importing sugar is because other countries, for example, excuse me, are going to have a comparative advantage, meaning they can produce sugar more cheaply than the US. So as a result, the going world price of, say, $100 per metric ton is less than, say, the $250 it would be in the US if there were no imports. Again, the idea is that other countries relative to the US have a comparative advantage. And so if the going world price is $100, what will happen then in the US, total quantity demanded of sugar will be 350 units. But of that 350 units, only 50 of them will be produced by domestic US sugar producers, because that's where the supply curve intersects the going world price. And the intuition is pretty straightforward. US sugar makers, relatively speaking, aren't very good at producing sugar. So as a consequence, they don't produce very much, they don't do very much business. The difference between the 50 units produced in the US and the 350 units produced elsewhere, 300 units, that's imports. So the US would import 300 units of sugar. Now, let's suppose we have a tariff that's imposed of $100 per metric ton. And so what this would do, price would go from 100 to 200 to tax. And so what we want to see is what impact would this have? Well, I'm going to skip over some details on some microeconomic concepts, but the key here is that I'm going to outline this area here. This whole area, this whole outlined area, that's lost consumer surplus. And the idea is that consumers lose surplus because some consumers are simply priced out of the market, and all the remaining consumers pay now $100 more per ton than they used to. So the consumers are clearly worse off. So again, that shaded area there, that trapezoid, is the lost aggregate consumer surplus. So let's see where that consumer surplus goes. Some of it, this shaded area right here, some of that lost consumer surplus goes to or becomes producer surplus, and the intuition there is pretty good. Domestic firms now can sell sugar at $200 per metric ton. And so, big surprise, domestic producers increase their production. And so since they can sell more sugar at a higher price, they generate more of what's called consumer surplus, that shaded area there that I just created. Some of the lost consumer surplus, the rectangle here, area E, that goes to the government now in form of tariff revenue. The idea being is as the price is pushed up to $200, imports decline. Imports used to be 300 units. Now imports are only 100 units. So 100 units of imports times $100 per metric ton. That's the tariff revenue generated from the imposition of the tariffs on sugar. So some of the lost consumer surplus goes to the government in the form of tariff revenue. However, the other two shaded areas here, let me change colors here. Let me go green, blue, is the two purple triangles. The sum of those, that's the deadweight loss. Part of the deadweight loss is from the fact that over here, area F, for example, that's the lost consumer surplus from some consumers being priced out of the market. Some buyers buy less sugar or stop buying sugar because the price has gone from 100 to 200. So any consumer surplus they had simply disappears. On the other side, the shaded triangle area D, that's also a deadweight loss because now society is producing more sugar than is socially optimal. So that extra sugar production requires extra resources that were not previously used. And despite the fact that that might benefit particular suppliers and so forth, is still an aggregate deadweight loss. So when you combine area D and F, that represents the deadweight loss to the imposition of a tariff. So now what we want to do here is move to the macro level. So at this particular point in time, in March 2025, there's a great deal of uncertainty. And so here are some of the questions, that are still to be determined. Which goods could be tariffed? What will the tariff rate be? Will the rate rise or fall? And how long will the tariff last? And then will there be retaliatory tariffs? And then that retaliatory tariffs, those imply those same four questions. Well, okay, what goods from the US will be tariffed by other countries? What will that tariff rate be, etc.? And so the bottom line is there's a big increase in uncertainty, and I'll show you a good visual here in a minute. And the idea here is pretty important, that higher uncertainty within the economy acts effectively as a negative demand shock. So for example, businesses may hold off on making investment decisions, hiring decisions, and so forth, And collectively, that can work to reduce the ag demand curve. And so there's a very interesting piece of data, the US Policy Uncertainty Index. And this is calculated by looking at a number of metrics, including, for example, newspapers and the articles that show up there and how often they mention certain words, like, for example, uncertainty. And you can see here that during the pandemic, this spiked. And then here we are now with another dramatic spike caused certainly by the increase in the uncertainty around tariffs and about government policy in general. And so why is the current possibility of tariffs such a problem? Well, if you look at the fraction of US GDP that is trade related, either exports, imports, it's dramatically larger, as we'll see. We've got a good visual here in a minute, than when the Smoot-Hawley tariffs were imposed in the 1930s. So the idea is way more jobs in both importing industries and exporting industries are at risk. And what the idea that we want to think about is that one of the intents is to protect U.S. industries. The problem is there are extremely few, goods that are 100% made in America. Even consider automobiles. That's one of the intents of the Trump administration, is to protect the U.S. auto industry. Even with automobiles that are assembled, I'm using very specific terminology here, assembled in the U.S., they contain a great number of imported parts. They contain imported aluminum and they contain imported steel. And so tariffs on those items crossing, for example, back and forth between Canada, the US, and Mexico will increase, perhaps dramatically, production costs of even US assembled vehicles. And where we are now, again, things are certainly not 100% certain, that final imported goods can be taxed, raw materials might be taxed, and then various intermediate goods might be taxed. And so all those, for example, will, the raw materials and the intermediate goods will go into, for example, the production of automobiles. So here's an interesting visual. This is the fraction of trade. In other words, the ratio of exports to GDP and the ratio of imports to GDP, and then you sum those up. And you can see that starting in the 1940s, there's been a dramatic increase in the share of US GDP that's associated with the international sector. But then here's a more recent graph that goes through 2024. And you can see that over the last 15-ish years, plus or minus, that this ratio has stalled out. Even in the 80s and the 90s, it grew reasonably well. But thanks to COVID, thanks to Great Recession, so forth, thanks to tariffs from the first Trump administration, trade has slowed down as a percent of GDP. Likewise, tariffs. Here's a chart from the Pew Research Center that calculates average tariff rates going all the way back into the 1800s. And you can see this dramatic spike right here. Those are the Smoot-Hawley tariffs. But then notice the gigantic and sustained long downward trend in average tariff rate. First, we had the General Agreement on Tariffs and Trade, GATT, and then we had the World Trade Organization, WTO. So on average, US tariffs have fallen very dramatically. And other countries have also reduced their tariffs as well. And that's been an important factor in driving up trade around the world. More recently, here's zeroing in from the 1930s on to now. So right here, those are the Smoot-Hawley tariffs. This is the average tariffs, average tariff rate on US goods that are imported. And then you can see the aftermath of the Second World War, and then through the 70s and the 80s and the 90s and so forth, the general downward trend in tariffs. Here you can see the little upward bump thanks to the tariffs imposed in the first Trump administration. And then here in the very far right, you can see the proposed tariff rates. And these would rise dramatically and would reach multi-decade highs potentially. So here's the bottom line. Millions of US jobs depend on imports. Millions of other US jobs depend on exports from the US to other countries. And so if the US imposes tariffs and our trading partners impose retaliatory tariffs, that's going to disrupt worldwide supply chains. And so what tends to happen then is we'll get a more inefficient allocation of resources. And what this will do is reduce the standard of living, not just in the US, but our trading partners as well. And it will have some other knock-on effects too. Could damage the standing of the US in the world economy, and also, and we'll talk about here in a few minutes, have long-run impacts even once the tariffs perhaps are removed. So, consider, for example, some company who, in response to tariffs, reorganizes their supply chains. Suppose they move them from, say China to, Malaysia or perhaps, Vietnam. Well, that's that reorganization is relatively costly. Change factories, build new factories, relocate employees, etc. So suppose the tariffs end. Well, companies simply might not find it worthwhile to reorganize again, so they're left with a relatively less efficient supply chain. Now let's turn to the macroeconomic impacts of tariffs themselves. So here's one of the problems that policymakers face. As we'll see here, tariffs cause both a negative supply shock and perhaps a negative demand shock as well. So, for example, when the US imposes tariffs, what this does, at least initially, is reduces, and we'll show this visual in just a minute, the short-run aggregate supply curve. In other words, the ability of firms to produce output in the short run. We'll also talk in a few minutes about, well, might it also affect the economy's long-run ability to produce output, to produce goods and services. On the other hand, when countries impose retaliatory tariffs, that reduces US exports. That works to push down US aggregate demand. And when you combine that decline in aggregate demand with the decline in aggregate demand caused by the uncertainty we talked about a couple of minutes ago, that might push down aggregate demand even more. What's key here is both a negative supply shock and a negative demand shock will reduce both GDP and employment, or alternatively raise unemployment. However, as we'll see in just a second, the impact on inflation is somewhat less clear. But what we can say, though, is that long as tariff rates don't continually keep rising, in other words, they're imposed and then they stop, they don't go up anymore, the impact on inflation is going to be relatively temporary. However, the impact on the price level might be longer lived. That is, of course, unless tariffs are somehow removed or perhaps even reduced. Okay, so let's use the trusty aggregate demand aggregate supply model to visualize this. So first we have the long-run aggregate supply curve, vertical at Y star. That represents the economy's maximum sustainable capacity. Again, the key is sustainable capacity. You have the aggregate demand curve, which can be thought of as consumption, investment, government spending, and net exports, the famous C plus I plus G plus NX. And then the short-run supply curve, which gives us information on firm decision-making in the short run in terms of their production decisions relative to, say, changes in the price level, costs, and things like this. And so when there is tariffs are imposed by the US, effectively what this does is this will shift the short-run supply curve like so. So again, that's going to act as a negative supply shock. So other things equal, that's going to reduce GDP and raise prices. But on the other hand, retaliatory tariffs, they reduce aggregate demand. Oops, I got an extra 81 in there, and an extra 82, so we can cross those out. And here, what we see is the same impact on GDP and employment, a decrease, but now the lower demand curve causes or puts downward pressure on the price level. And so On the vertical axis, it's unclear. I've drawn it so that the price level, oops, P1 here is a little bit higher, than P0. But no matter what happens, real GDP is going to decline. So the economy will move from point A toward perhaps something like point B. So again, the impact on the price level might be uncertain, but the impact on GDP and employment is going to be pretty clear, both in the downward direction. And so then the question is, well, what should the central bank do? So in the US, that's the Fed. What should the Fed do in response to a tariff war? And so it's been pretty helpful is that there's been a decent amount of research recently in terms of, what's the right move for central banks in response to a tariff battle. Now, the general conclusion is what they should do is they should pursue an expansionary policy to offset the decline in GDP and employment. And this is especially the case if retaliatory tariffs are enacted, because those, as we just saw, those negatively impact aggregate demand. There might be a cost, however, of an increased inflation, but that might only be, hopefully, temporary. And so the idea is what monetary policy should do is, to the extent that it's able, is to shift the aggregate demand curve back to try to mitigate the damage from the tariffs and the retaliatory tariffs. Those we'll talk about in a few minutes. They can't completely undo the damage. Okay. So, for example, recent paper by Bergen and Corsetti is they examine a whole bunch of scenarios in a simulated model of the economy. And so in one scenario that's particularly important to the US, the country imposes tariffs like the US is doing, has retaliatory tariffs imposed like other countries are doing, and we'll talk about this in a couple of minutes, has what's called a dominant currency. In other words, a currency that's heavily used in settling of world trade, major foreign exchange transactions, and so forth. And here's what they find, and we got a visual in this in just a second. Relative to doing nothing, an expansionary policy, in other words, increasing aggregate demand, lowering the federal funds rate, for example, produces better outcomes, especially for GDP and employment, without having that much of an impact on inflation. And the intuition here is really pretty good, because both tariffs from the US and retaliatory tariffs from our trading partners reduce GDP and employment. And the retaliation works to lower inflation. There we go, lower inflation. Monetary policy has some maneuvering room to not worry so much about raising inflation when they pursue an expansionary policy. In other words, the retaliation and its downward pressure on inflation gives a central bank, gives the Fed a little bit of maneuvering room so that it doesn't, hopefully, if life is good and fair, have to face too much of a trade-off between higher inflation and higher GDP and employment. So here's a chart from their work. And so here, up on the left, this is the path of GDP in the home country, the US, in our example here. And notice you have the solid black line and the dotted line. The dotted line is, suppose the central bank does nothing. They simply let the tariffs and the retaliatory tariffs do their thing. Well, so that's the solid line here. You can see there's a material downward impact on GDP. But if they pursue an expansionary policy, they can notably mitigate the decline in real GDP. And in the next table here, doesn't do much to impact inflation. So notice the black line, the do something line, is only slightly higher than the do nothing line. And so here in this panel right there, that's lowering the interest rate and then over time increasing it again. And then this will be important for us in just a second, is the exchange rate. in other words, the value of the dollar compared to other currencies, notice that it declines, right? So again, this is a simulated model of the economy, but it tries to build in a number of realistic features, including, the initial tariffs, the retaliation, and the fact that the US dollar is a major world currency. So let's talk about this now for just a second. If you look at the fraction of world trade that's settled in US dollars, it's very high. Consider, for example, the world oil market almost exclusively settles in US dollars. And the US is a gigantic trading partner for most of the other leading countries. Think, for example, the EU. So when the Fed pursues an expansionary policy, to raise aggregate demand here, to mitigate the impact of the tariffs, what an expansionary monetary policy does, that's usually one of the most sure ways to depreciate a country's currency. In other words, depreciate the value of the US dollar compared to other currencies. A depreciated currency, other things equal, will tend to raise exports because it makes things priced in US dollars cheaper. And then domestically, the expansionary policy will work to increase the other components of aggregate demand. And so then, like we showed just before, the higher aggregate demand acts as kind of a cushion to mitigate the effects of the tariff war. But this is what we want to emphasize: it cannot eliminate all the costs, again, as long as the tariffs stay around. But what's crucial here is that to the extent the Fed can strengthen the US economy, a stronger US economy works to increase imports from other countries, despite the tariffs. And higher imports from other countries act as an increase in aggregate demand for those economies, and that supports their economic activity as well. So effectively, what the Fed is able to do to some extent is support global aggregate demand. So one thing we want to think about here is, will tariffs, for example, shift the long-run supply curve to the left? In other words, reduce the economy's sustainable growth rate or their sustainable output. And the answer to that question, unfortunately, is yes. And the idea is that the tariffs and the retaliatory tariffs will distort firm decision-making in terms of production away from the free trade equilibrium. And this distortion reduces efficiency and reduces, therefore, standards of living in both the US and our trading partners. So for example, consider the impact of import tariffs. So that raises the cost of various inputs. Consider, for example, aluminum and steel. And so those are now less available than they were. And so what this is going to do is increase production costs. And to the extent that domestic production substitutes for foreign production, what happens then is US produces more goods for which it doesn't have a comparative advantage. So US companies will produce more steel and more aluminum, which might be really good for them, to be sure. But any company that uses steel and aluminum in their production process is going to be made worse off. Okay? Now consider the retaliatory tariffs. Well, this reduces the demand for US goods. And what's key here is the reason we sell goods to other countries is because we have a comparative advantage there. And so what this will do is if we're selling fewer goods to other countries, this reduces production of goods in which the US has a comparative advantage. And so in short, what's going to happen is resources are not going to be as efficiently used as they could. And so here's the key, is that tariffs can do long-term damage. And these are the things that a central bank with its policy can mitigate, but cannot undo. So a couple last quick things here. So right now, and for a while, the US has been running a large trade deficit, which for all practical purposes is called a current account deficit. Current account also includes unilateral transfers back and forth between countries. But the key here is that for the US, that's mostly, for all practical purposes, the trade deficit. Is that accounting requires that for every dollar of trade deficit we have, in other words, a current account deficit, that we have a $1 capital account surplus. The capital account measures funds flowing into or out of the US to acquire either US assets or foreign assets. So if they flow into the US, that counts as a surplus. And so where's this inflow of funds going? Well, they're buying shares of US companies. They're funding US investment. They're buying US treasuries, real estate, and all kinds of other US assets. And so a trade deficit implies a net inflow of capital, and this inflow of capital is put to good uses throughout the US. Second thing to keep in mind, or to wonder about maybe, is, well, why is it that we run trade deficits, in the first place? So there's a basic macro equation, and I'm saving time here, and I'm not going to derive it, that national saving in a country is equal to the level of investment plus the level of net exports minus imports. National saving is equal to the sum of private saving. That's the saving that folks like us do and companies do, plus government saving, local, state, and federal. And since local and state governments pretty much have to run balanced budgets, but the federal government does not, and has been running a very large budget deficit, the idea here is that large federal budget deficits generate low national saving. And if we have low national saving and want to undertake relatively high investment, somehow that has to be funded. And so what occurs then is changes in interest rates, exchange rates, and other financial market and macro variables. They will adjust to make that equation balance out. And the result that we get is a trade deficit. And as we mentioned above, the concurrent capital account surplus, right? And so as a result, because the US runs a budget deficit, macro and financial market variables adjust such that we run a trade deficit, and as a result of that, we run a capital account surplus so that funds are flowing into the US to acquire US financial assets. So quick conclusion here. So tariffs can inflict both temporary and long-term damage on the overall macroeconomies of the US and of our trading partners. Retaliation makes this situation worse for both parties. I want to emphasize that very, very importantly. And while there are some domestic winners, to be sure, I mean, think, for example, US firms that face less foreign competition and don't have any of their inputs or intermediate goods that are tariffed, more or less everyone else loses. And also, monetary policy can mitigate by increasing aggregate demand, pursuing expansionary policy, but cannot, unfortunately, eliminate the damage thanks to the distortions that we talked about. All right, everybody, thank you so much.